Morning, Market Chameleons. Happy Tuesday morning, and where there he is, my favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Excellent. Let's get right to the disclaimer.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance.
Excellent.
Disclaimer.
So what are we thinking about doing this morning, D?
So I think we'll continue on the Q&A. Actually, we've been getting, I think, very good questions. People have been coming on live asking their questions. And I think what's important here is that the questions that we are getting are questions that people are encountering in the course of trading, right? So you could see that these are people actually giving us questions from experience that they've, that either through trading, they've ran into situations that they were unfamiliar with, or something happened they weren't expecting. And I think these are really good questions that we're getting. So let's stay on course there. Hopefully we get some more people who are brave enough to come on live and ask their questions. I think, when you come on there, the questions tend to be a little bit better because we could interact and ask questions around any surrounding circumstances. But if you have questions and you want to put it in the chat, Will's reading it and we'll try to get to those questions as well. If you have a question you think that is better asked, live, then Will's going to provide the link. You'll go over to where, like Zoom, raise your hand, and we'll bring you on live. You don't have to turn on your video camera, but we'll hear you through the audio. Is this correct, Will?
Perfect. And I put the Zoom link at the start of the YouTube chat, so you can click right on over, raise your hand, and let us know you have a question during the presentation. And if you put it in chat, we'll get to that as well. Either way.
Yep. And what I'll do is I'll start out, I'll go over what's going on right now in the pre-market. Then I'll take, if we, waiting for the questions to come in, I'll just start on my list of questions that I've been getting either through emails, through my conversations, or through chat, or through previous shows. I still made some notes, so I'll just start hitting on some of those questions until we get anybody coming in with any questions. And remember, this your chance to ask it, any of the questions now, and I think it'll be a big benefit also to the rest of the community, because either they might have the same question, or they'll get to hear something they haven't experienced yet. So with that, let's just take a look first on the pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here just to take a look at the list, and we got 62 that made our percentage gainers list, 55 on a percentage decliners list. So from there, kind of a mixed bag, a little bit more favorable towards a bullish side at the open. Let's take a look at the higher market cap stocks, see if we're seeing the same picture or anything different. So I'm using this market cap filter of 20 billion market cap or higher. And here I see that there are 21 that made our percentage gainers list, 14 on a percentage decliners list. So from that perspective, kind of mixed, but a little bit more favorable towards the bullish side. If there are no questions here, I'm going to kind of move on, take a look at some of the questions I have on my list. Will.
All right. Well, I did. There was a question about Square. Square yesterday, I was down, I think, in the pre-market on that takeover. I think they purchased a company yesterday.
Yep.
And at the end of the day, they finished up. I just wondered how you see the history of that, like what they've done in the past when they were off. I'm just wondering how that looks.
It was very news specific driven, yeah. Right? So Square had a couple things going on yesterday. I think they also reported earnings after that. But people, in the beginning, it's like anything, you got to take a look at the news, read the stories, and the first reaction could be the wrong reaction, right? I think as the news developed, I think that they were talking about Square's earnings, that they were doing well, and maybe the explanation behind the merger right, started to make sense to people. So it definitely reversed course. It's a news driven event. So you got to take that into consideration. What's the news? What are they saying? How are people interpreting it going forward, right? And it looks to me like, that based on what I believe that they had earnings yesterday too, right?
I think you're right.
Right. So they came out right with earnings, and also then they came out with that news, and I think that people warmed up to that merger. So again, look, it's it's up to you to kind of go in there, read the news, and make a decision. And sometimes the first reaction, even when somebody reports earnings, right? Like when you report earnings and you could have a beat, right? And the first reaction is to buy the stock, but then it depends on what the company says in their press release, what they're conveying going forward. How does their future look? And you could have an earnings beat and the stock will be down, or you could have an earnings miss. The first reaction is to sell, but then they give you an explanation. And if they're optimistic about the future, the stock could be up. So it's important once you start entering in like a news driven event, you have to kind of go in there and like read the news and make that decision.
Very cool. Thanks, D.
Yep. Were there any other questions about it, or that was kind of it? Look,
That was kind of it. That was perfect. Thanks.
General question. Yep. So while we're waiting, if there are any more questions coming in, I'll just start on another example. I think we talked about a risk reversal, and we kind of left it open. But before we get into a risk reversal, I'm going to just use SPY as an example. Let's kind of come out here. I'm going to come out here too. I'm going to pick on purpose right now an expiration right before a dividend. So I see dividends coming up like around this expiration. So let's start with September 10th. And a risk reversal, there was a question, if I buy a call here, to the upside, I could sell a put to the downside. There's an implied volatility skew. Why don't I do that? But before I get into, and this is what it looks like, a payout diagram. But there are different risks associated with the risk reversal. One of them, though, before we talk about the implied volatility crossing strikes, is it has to do with cost of carry. Okay, and we don't really get into that, but I feel like the questions we've been getting are pretty good. So let me do a demonstration, what I mean. And when we look at options, right, there's a cost of carry component to it. So let's just take a look at what I mean. So if I do this option, here's this, closed around 437.50, right? So if I sell this call, the 437.5 call, and I buy the put on the same strike, right? So right now we're going to do on the same strike. So sold the call, I bought the put. This is what the payout diagram looks like, right? As the stock goes down, we're making money because we're long the put, right? And we sold the call, so whatever money we collected to the call, as if it goes below the strike, the call will be worthless at expiration, but the put will keep going up as the stock's going down 1 for 1. So here we're synthetically short the strike. Synthetically, we're short the strike. And let's say, we see that the midpoint is 6 cents. So, we get a 2-cent credit for that. We sold the call for $8.47. We bought the put for $8.45. Let's say we did it a little bit closer. So I'm going to just change this. And let's say we sold this call for $8.50. So we got like 5 cents credit. I'm going to reload this. So let's just say we got 5 cents credit. And since we're synthetically short this stock, okay, there's a way to hedge it. I could just buy the stock, and and I got a hedge position, right? So look how that looks. I'm gonna buy this stock, 100 shares. Let's load that up. So look, no matter where the stock goes, right? It goes up or down. If we sold it for 5 cents credit, we're going to keep that 5 cents because at expiration, if the stock went all the way down, we lost on our stock, made on the put. At expiration, they offset. I get to keep the difference. If it goes way up, right? Well, I'm losing on the call, but I'm making on the stock and they offset at expiration. So now I'm looking at this, and why would I want to do this? Like, first, let's just step back and what did we just do here? Okay. So this is what we just did. When we synthetically sold this, by doing the conversion reversal, we synthetically got short and then we got long. Now, this is based on cost of carry. Okay. So by looking at the options, when I did this, I lent out basically for 5 cents and I locked it in. Okay. So my lending rate is fixed. But what did I do to hedge it? I bought stock. So when I'm buying stock, right, there are two ways to do it. One is you take cash that you're making interest on in the bank. You take that cash out and you buy the stock. So you're foregoing the interest that you're making, or you have to borrow money, right, from your bank or from your broker. You borrow money and you buy that stock on borrowed money. So what happened here is, in this situation, you're lending out at a fixed rate and you're borrowing at a variable rate, right? So if you're borrowing from a bank to buy this stock, they're going to charge you based every day that you don't pay back. They're going to charge you the rate, the going rate. So in this situation, there are a couple different ways what you're looking at, right, in the cost of carry. One is interest rates. So if interest rates go down, in this situation, it'll be good for you because you locked in a fixed rate that you're lending at, right? Whatever this comes out to, lending at earning 5 cents next, 20 business days, whatever calendar days that happens. I lock that in, but the rate I'm borrowing in, right, could be variable. So if it drops to zero, if I could borrow at 0%, then I would lock in this 5 cents. It's not realistic. And of course, you have to take into consideration any commissions, right? This is just pretending there's no commissions and so forth. So that's one way, right? What we're doing is lending at a fixed rate in this situation, borrowing at a variable rate. Another thing why you would want to do this potentially is if you think that this stock could become hard to borrow. So what does that mean? Well, sometimes people want to short a stock. And to short a stock, first you have to locate it and borrow it from somebody, right? You can't just short a stock. You have to go to the stock loan market, right? And say, well, how can I borrow the stock? How much will it cost me to borrow because I want to short it? Sometimes it's free. If your broker has a ton of it, they'll just do it to generate commission. But sometimes it becomes hard to borrow and there's a lending rate. In other words, well, I need to short it. I think it's going down, but it's nobody's lending it, so I'm willing to pay a fee. And that becomes hard to borrow. And that fee will also get reflected in the options market, or there'll be an arbitrage. So what you'll see is that put that you own will start becoming more valuable because people want to short it, so they're buying puts, and the call that you sold will start coming down because that's another way to short, right? To sell the calls. So in this situation, right, what we did was we looked at two things. We looked at one way is that the variable rate, the borrow rate can decline, but you already locked in a higher rate, or that specific stock that you now are long can be hard to borrow. So you're going to earn interest. You could earn interest, right? It'll be reflected in the options market, but you could earn interest now lending out that stock, but you're still perfectly hedged on that delta. The third way is on the dividend. So I skipped on this dividend, but let's say there's a dividend in this stock, right? So you would have to own the options. You'd have to do it in an expiration past the dividend date. But if you're long a stock, and let's say everybody's expecting a 50-cent dividend, right? So the options will reflect that 50-cent dividend in the options pricing model. But if you're long the stock and they increase the dividend to, let's say, 65 cents, well, you locked in the options market, you locked in with the estimate that it'll be 50 cents, but you actually, if you receive 65 cents, then you made an extra 15 cents above where you locked in the dividend. So is that so far making sense to people? Like the cost of carry, once you start actually, not speculating, but trading and looking at financial models, cost of carry becomes an important part of that analysis, what you're doing. So when you're doing even a risk reversal, that cost of carry is important, that needs to be taken into consideration. That's why we run theoreticals and estimates using financial models. Any questions so far, Will?
Yep, you're good, buddy.
Okay. So what about on the flip side, right? So that's assuming, right, we're synthetically short and then we're long the stock against it. Let's do it the other way now. So now let's say we buy the call, we sell the put, right? Let's say we're paying here 10 cents. Okay, so what we did was we got synthetically long, right? So synthetically we're long the stock, because if the stock goes up, the put becomes worthless above the strike at expiration, and the call goes up 1-for-1 with the stock. If it goes down, right, the short put, we start losing 1-for-1, and the call will become worthless. So synthetically, we're long the stock here. Now to hedge that, we could just sell the stock. So here we could see, since we paid 10 cents for it, if nothing happens at the end of the day, at expiration, we lose that amount. So why would somebody want to do this? What would be the play? Why would you want to be short stock? Anybody want to guess out there? Let me know if you get any guesses. Like what would be the reason somebody would want to do the reverse like this?
Any question? I mean, we are on it's almost like a 2-minute delay.
Oh, really? Okay, then I'll just answer. Yes, let's not wait down. Okay, so now you're short the stock.
Hey, D.
Wait, yep.
You just went underwater. You may want to either reset your mic or step out and reconnect.
Is that any better if I get closer to it?
Nah, it's all garbled.
Really? Okay, let me step out.
All right. As D steps out, the question was, why would you do the short side of the risk reversal and be short the stock? If you want to answer that, feel free. If you want to, Alex, jump in with dividend. Good thought for sure. Anyone wants to ask questions live, the link is 2 places on the chat. You come over to the Zoom, and we have Bob is raising his hand. So when D comes back, not
Well, hello?
Can everyone hear us now? Am I back? Yep. All right, everyone can hear me. D, you got to come back in. Sorry about that, guys. I got to send a text to D to come back in.
Hello?
You there?
Yep.
Yeah, that was strange. Something shot me down too, so we both went out. But we do have a live question, D. Are you ready to take it? Jump right back into it?
Yeah,
All
sure.
right, Bob, we're going to allow you in. Here we go. All right, Bob.
Hey, Bob, you're on mute. You just unmute your mic.
You're on, it looks like, Bob. What's your question?
We can't hear you, Bob.
Bob may be having technical difficulties. He is raising his hand. I think that may be Rob from Chicagoland.
Okay.
Bob, if you may want to log back out and hit the link and try coming back in. But we can wait to see if Bob gets back, D.
Yeah. Okay. Yeah, we can't hear you though. It might be an issue with the mic or, maybe that glitch. So let me come back to it while we're waiting. Let me know if you have any other questions coming in. For now, I'll just share my screen, come back to it, and we'll just continue on the path with this scenario. So what I did here was synthetically, I got long the stock, and then to hedge it, I sold short the stock in the same quantity. We paid net debit for it, 10 cents. So now we're short the stock. So what are we? So
hey, D, we did have a couple guesses, by the way. Do you want to hear them?
Yeah.
I think it was, let me go back. It was right before I think Alex said dividend with a question mark.
Yep.
And Chuck was saying to buy it at a discount and possibly lower your cost average.
Okay, close. Some of them are, yeah, I'll explain it. I think these are close but need explanations.
All right, we're going to try Bob one more time, Bill. D, okay. Is that all right?
Yeah.
All right, Bob, we're going to try again. Here you go. Hey, Bob, can you hear us? Unfortunately, it doesn't seem to be working. Sorry about that, Rob. We really appreciate you trying to come in. Sorry, D. I don't know if we did have a new Zoom download come in. Did you download the new Zoom on your computer?
I don't think so. Not today. So
I got an alert to do it this morning, so maybe it's on my end. I'm not exactly sure. Sorry about that, Bob. We tried.
Okay. So those are pretty good answers. So yes, now you're short the stock and you're hedged, right? So you kind of locked in that long synthetic, and you're going to pay 10 cents for it. Since we're short the stock, right? You borrowed it, you shorted it. Let's say you borrowed it at 0%, right? Like your broker just said, yeah, I have a ton of this stock here. You can borrow it. You shorted it. Well, when you short it, money comes in, right? So whatever you sold it for, that money comes in and sits in your brokerage account. So if the interest rates go up, then so every day that you have money in there, you'll start earning more and more interest as interest rates are going up. But you locked in, right? You locked in the interest rates that you're borrowing at. So you already locked that in, and now you're lending at a variable rate. So if the interest rates go up, that will be good for you, and it'll start getting reflected in the options, right? Because you're earning. So the idea is, if interest rates go up on your short stock, you earn more interest to offset this 10 cents, and then anything above that you would keep. Another is a dividend, right? So you did price in, let's say there's a dividend, and you priced in with the assumption that if you're short the stock and there's going to be a dividend of 50 cents, well, you owe that dividend to whoever you borrowed it from, right? You're borrowing their stock, but the agreement is that, you anytime they need it back, you'll have to return it. And if there's a dividend, well, they're owed that dividend, right? So you have to pay them that dividend, like a substitute dividend, basically, because they would have been owed it. So if the dividend goes down, or like say they cancel the dividend, well, you'll either owe less or nothing potentially. But in the options, you've already locked in some estimated dividend, right? So if you're assuming that, hey, the dividend people are pricing it is too high, or there's a good chance they're going to cut it and it's not priced in, that is another play. Another one is you will see it as sometimes the options market are reflecting a hard to borrow situation, right? So when it's a hard to borrow situation, you might be paying to short this stock, right? You need to borrow it, you're paying somebody a fee, and you might have locked in, because that fee is reflected in the options market. Well, sometimes that fee could go down, right? So you're assuming, hey, it's going to cost me 10% annually to borrow, and you have this position on that, you're paying 10%, receiving it from the options market. But if that fee goes down, that'll be good for you because now you're paying less, right? And sometimes there will be reasons it could go down. Maybe there's, a lockup period and it's hard to borrow, but and this is a popular strategy, right? People look up these lockup periods, because once a stock is unlocked, then it's made available. The brokerage, people could either sell their stock or they could lend it out to their brokerage. So all of a sudden, maybe an unlockup period could bring 20-30% more inventory to the market than there used to be, and that borrow fee comes down. So those are a couple different ways, looking at, and it's important to know them almost on any strategy that you're using, because it impacts no matter, I'm just showing you here a conversion reversal example, but that will be the case, even if you're just buying a call, put strategies, you have that cost of carry that is priced into the options. Hopefully this was a helpful example. I got like a minute left, Will. I don't know if you have any questions just queued up.
No quick questions, D. But I think this Q&A format is going well, so I'm assuming we'll continue it at least till we run out of questions.
Yeah, hopefully tomorrow we have better luck with the Zoom.
Yeah, Rob, if you want to send me an email, williammcbride@gmail.com. Actually, I see your email this morning came back to support. Actually, Rob emailed us about some questions, D. Earlier this morning. If you want to email me, Rob, maybe we can set up a Zoom and we can test out your mic. Sometimes it may be just figuring something out.
Yeah,
but
sorry,
either way, it's fine. We do appreciate the effort. Anyone can come on live. We'll put the link on every day going forward. And those questions are super helpful. It's worth the effort trying to get people on live. That's for sure. Thanks, Dima.
All right. Thanks, everyone. Stay safe out there. Have a good trading day, and hope to see